Welcome to the September edition of Making Sense of the Markets with Chris Kerlow and Team LWC. As always, my name is Mitchell Shields. I'm the financial planner with Team LWC, and I'm going to be moderating the session this evening. So before we jump into things, just some housekeeping. Within the Zoom session, there's a Q&A function. I'm going to be watching that Q&A box. If you have any questions that come up through the conversation, right as you think about them, just throw them in that Q&A box, and I'll make sure that we address those at the end of the call today. Also, you'll have the option, of course, to jump off mute, but I find most people enjoy using that question and answer box. We'll save that till the end. Chris titled this session, "'Tis the Season." He's going to be talking today about central bank policies and the effects on the markets. He's going to be talking about alternative currencies and some of our thoughts there, and also spending some time talking about cash. And like I said, I'll save the questions for at the end, but I think we've got a good amount of people who have trickled in. So without further ado, I'm going to pass things over to Chris to get started.
Thanks, Mitchell. Hello, everybody. Thanks for joining us. "'Tis the Season" is referring to the seasonally challenging times that we experience in the late summer into early fall, typically in equity markets. It's a topic that we discussed in detail during last month's investment committee meeting, and has kind of driven us to remain flush with a bit of cash moving into this typically more challenging time. But all eyes remain on the central banks. We saw the Bank of Canada hold the overnight rate at 5% last week, or on Wednesday. And so, but they were very hawkish in their tone, really reiterating that more rate hikes are on the table should the data remain strong. The next decision here in Canada is October 25th, so we'll be keeping a close eye on that. One of the reasons central banks around the world are becoming increasingly concerned has been the recent rise in oil prices. We've seen WTI approaching $90 a barrel. Talk a little bit about oil in the future slides. And then what we're really wondering, is this a pause in the rally like we saw in the spring of 2018 or the fall of 2020, or is it going to be more of a correction like we saw in the fall of 18 and the spring of 2020 during the pandemic? And then we all remember 2022, the challenging times we had there. Our thoughts right now, and have been maybe a little ahead of consensus, is this weaker or less weak kind of recession, this soft landing as it's being dubbed. But with that said, we are seeing expectations moving into next year for a period of economic weakness. We've kind of seen GDP expectations falling in both Canada, the United States, as well as in Europe. And the Fed on the other side of the border is painting a bit of a less rosy picture, despite seeing unemployment and GDP remaining persistently strong. This chart on the left shows us GDP now, which is an indication of the current GDP at this moment in time. This is done by the Atlanta Fed. That's at about 5%. And then the unemployment rate, has trended down since COVID and remains below 4%. In the United States, again, a very secular low level that people tend to not be too concerned about. But we are sitting at historically high cash levels. Several reasons for that, some of which I've talked about, but the sluggish growth out of China doesn't seem to be getting any better. Headline by slowing inflation and a weakening middle class. We look across the pond to Europe. The chart on the top right is showing you the Purchasing Manager Index. That's basically an expectation from the manufacturing sector. You could see the big powerhouses in France and Germany. A reading below 50 is in contraction territory. A reading above 50 is in expansion territory. And you can see that all came in below expectations and are now deeply into that contraction area of the market. That's not posing well, again, for their trading partners in China and Japan. And you kind of have this global intertwined economy. So a softening in the European economy does have the ability to have contagion risk across the globe. All of this comes at the same time of weakening seasonally adjusted expectations. And so as I mentioned, consensus for 2024 is weakening. Fortunately, higher bond yields have led to an opportunity to earn a high amount of interest in low risk government bonds or high interest savings accounts. We fortuitously, during the end of July, as intermarket correlations fell, raised some cash, trimming a bit of our profits in Uber, remained at these elevated cash levels. The debate this month really was, do we buy the dip or do we kind of sit on the sidelines for a little bit longer? We've decided to kind of maintain that higher cash percentage. But again, I've seen in the chart on the bottom right, your short-term yields are ticking higher, earning close to or above 5% in a lot of the investments that we're sitting in on that side. And, should we see kind of those intermarket correlations rise, it's a bit of a contrarian indicator. You'd likely see us moving back into the market, or should we see kind of expectations changing in a variety of the forward-looking indicators that we're looking at? Economically, we are less concerned that we're going to get that deep drawdown recession here in North America, but we just think from a market standpoint, it's going to be better to sit on the sidelines just a little bit longer. One of the areas we are getting more excited about is the oil sector, particularly upstream and exploration. So kind of the two tips of the process. We've seen Saudi Arabia extend their production cuts out to the end of the year, while the US is ticking higher from production as well as consumption, both bullish signs for the United States oil complex. Saudi Arabia is kind of keeping their foot off the gas pedal to help keep those prices elevated. We wouldn't be surprised if they did that all the way up into the $100 range, which can be quite lucrative for the players in that space. We also seen crude oil production at an average of about 12.8 million barrels a day in the United States and ramping up to 13.1. Both would be annual records, which bodes well for the producers and the people getting that oil to market. And then the EIA revisions for demand have been better than expected. And so higher demand offset and then higher supply offset by lower supply internationally does pose like a bit of a Goldilocks scenario for the energy space, particularly south of the border, as well as in different areas of the market here in Canada. So it's an area that we've been exploring on potentially adding more exposure to. And should we do so, you'd be receiving that information in our ongoing trade rationales. The banking sector is an area of the market we've become a little less sanguine on, even though valuations do seem reasonable. They're not overly attractive and has us underweight the sub-industry. The banks are a big part of our benchmark here in Canada. We own meaningful positions in both TD and BNS, but earnings revisions have been guided lower and could potentially see that, as well as expenses continued to grow. Both RBC and TD and Scotia saw 20+% expense growth, which is a big part of that's been driven by, and you could see some more restructuring charges around that, potentially in the tune of about $3 billion. That is all coming in at the same time. Loan loss provisions are rising, as shown by the chart on the right. And so these loan loss provisions are essentially a hit to net income as they take place. That does unwind if the loan losses are not realized. And so that could be a boon in the future, but we just think it's a little bit late. And should inflation persist into 2024, there's a chance that the US regional banks get downgraded, which would not be a positive for the likes of TD, BMO, and RBC, all that have quasi-regional banking coverage there. And other pockets of concern are out there, such as a review of the covered bond report that revealed that approximately half of the mortgages, variable rate mortgages in Canada, are negatively amortizing, meaning that your mortgage amount due is growing, not shrinking, as you continue to pay off that capped rate. This ratio really applies to BMO and CIBC. two banks we don't really have exposure to. But the saving grace in that is that very few of those negative amortizing mortgages have high loan to value ratios. So basically the banks are kind of protected by those strong loan to value ratios. And so although the banks look cheap at these levels, we're not adding right now and remain slightly underweight that subsector. We've been taking a lot of calls from clients and otherwise about alternative currencies. In our model portfolios, we do have a small position in Ethereum in the form of a covered call. That covered call overlay does two things for us. One is that it dampens the volatility. This asset class is quite volatile. Two is that it provides a level of income and substantial income. Because of that volatility, you can actually write calls at a very high level. And then lastly, we moved out of that Bitcoin in 2022 into Ethereum for a few reasons, but one was a tax loss. Bitcoin had a challenging year in 22, so we realized that, moved into a different alternative currency, and now we're actually discussing reversing that trade and coming back into Bitcoin as we see a few catalysts on the horizon. One is something called the halving. This has taken place in 2016 and 2020. Will happen again here in April of 2024. Following that, the last two periods, you saw a prolific run in the price of the cryptocurrency. And so, you don't want to typically wait for it, but we are using more technical indicators as the fundamentals around Bitcoin are limited. But a couple of them are real. One is the money supply in the United States has grown at a faster pace than the amount of Bitcoin in supply. And so you have this dollar for dollar or dollar per coin ratio that continues to move in the advantage of Bitcoin, where there'll be a maximum of 22 million ever created, and it seems like an endless supply of US dollars is on the table. And then secondly is in countries that currency devaluation is a real thing. Fortunately, where we sit in Canada, even though you and your friends probably opine about $1.30 or $1.35 or $1.25 Canadian dollars per US dollar as an important thing, looking at it penny by penny. My friends in Argentina talked about a 22% devaluation of their currency last week. My friends in Bolivia can't access US dollars in the traditional banking system and have to buy physical cash on the streets. In these type of countries, if your dream is to save for, or the American dream, save for a home and go buy a house in the United States and provide a better life for your family, you need an ulterior place to park your cash. Gold could be an option, but there is actual more physical and real threat to storing large amounts of gold in your house if you're not willing to trust or use the banking system in your respective country. And so Bitcoin does serve as a form of currency support. You can see here it's up 58% versus the US dollar this year, where Argentinian peso, Venezuela, Russia, China, all down meaningfully. And if you're doing your best to save in those countries for US dollar home purchases or otherwise, it really didn't do its job. And so we look at this as really an alternative asset class. There is a level of risk on correlation, and why we probably haven't added just yet, where as of late you see a lot of correlation with the NASDAQ. And so we're waiting for more of a technical pivot before possibly adding a bit more to that position.